Good morning, everyone. My name is Jonathan Levine. I'm a columnist with Bloomberg Opinion. I'm here with Kathryn Rooney Vera, Chief Market Strategist with StoneX, and Kayla Bruun, Lead Economist with Morning Consult. We're here to talk about CPI Day. The expectation from the Median Economist survey by Bloomberg is that CPI month on month will have increased 0.2% in the month of October from the previous period. On the core, which excludes that volatile food and energy, you'd be looking at a 0.3%. And then translating all of that into year-on-year figures, it would be a 2.6% for your headline CPI and a 3.3% ex food and energy. Kathryn, let me go ahead and kick it over to you. What's your expectation here? And I'd also love for you to comment on how much does this and the rest of the data flow matter at this point, given that we're in between the election and inauguration day for an administration that really seems to want to shake things up on the macroeconomic stage quite a bit?
Good morning, John. Such a pleasure to join you on the all-important CPI Day. But I'll tell you what, it feels less important now. I don't think as many people are as glued to the screens, waiting in breathless anticipation for that 8:30 print, just because the change could be monumental and coming up with a change in potentially fiscal policy, structural reforms, and monetary policy. So yeah, we're all curious as to whether this disinflationary trend that we've been living for the past many months, more than a year, is set to continue or potentially reverse. So that's my biggest concern, and something that I've been talking about to our institutional clients at StoneX for some time, Jonathan. But I generally concur with the Bloomberg forecasts. I think it's a pretty safe bet. I think headline CPI is likely to stay low. We've seen falling energy prices, and that's a good thing. Core CPI, of course, is going to, I think, remain on the sticky side. We have seasonal factors. I think you had mentioned used cars. That'll come back to haunt us. And I think that that health insurance price pressure should also come into play today.
Okay. Well, what about you, Kayla? How are you thinking about this? And you know what? One thing I'd love to hear from you on the back of this this election and heading into 2025 is just like, how are consumers and households dealing with this inflation story? You know, some 3 years and change after it all started in 2021.
Yeah, and that's a really interesting part of it that we follow really closely at Morning Consult. We ask, thousands of consumers questions about sentiment, inflation expectations, their household finances every month. So my team has been very closely watching the consumer experience, which, as we all know, their experience with inflation seemed to play a very large role in determining the outcome of the election. For that reason, I think I understand that some people maybe aren't watching this as closely, and there has been a little bit of a divorce between what's actually happening with headline inflation and how consumers are feeling. But there seem to be a lot of kind of upside risks in there that could really sort of reawaken this dragon that's been a big, looming very large in consumer mindsets for years. And even as we've seen so much progress in inflation, consumers have not felt that. This is pretty well known now, but we've seen it over and over again in our surveys. It is the price levels and the cost of living that's really bothering consumers. They don't care if it's close to 2% year over year.
Right.
Yeah. Wait, so you said that there are some points of concern for you that you think could reawaken the dragon. What are those, Kayla?
Well, I mean, there is also still reason to be optimistic, but even just looking at, if you look at all these big components that Powell likes to talk about, there's the goods, there's the housing, and and services excluding housing. For now, we can kind of strip out energy and food, really focusing on the core components. That's really where we're looking. And I'm kind of seeing upside risks in all of those. On the housing side, we may continue to see progress. We had a lot of influx of supply and rentals. I'm a little skeptical how far it will come down. It's probably going to stay a little elevated. On the
Yeah.
services side
And
now, we're
I
seeing
will cut you off. I will cut you off just real quick because we have the number here, and it comes in as 0.3% on core. That's X food and energy, and 0.2% on the headline. The year on year 2.6% as expected, 3.3% year on year on the core, again as expected. And so this comes in exactly in line with the Bloomberg survey. I will just real quick go over to a little bit of market reaction for folks. You do see a little bit of knee-jerk relief in the 10-year Treasury note yield. Just off the back of that report, we fall from we had been trading around 4.43%, and the knee-jerk reaction takes us all the way down to 4.37%. And that's a big reaction for essentially an inline number, but I think it just tells you something about the setup. It had just been like anxiety in this market heading into this number. A lot of focus on maybe not worst case scenarios under the new administration, but reasonably bad scenarios, so folks were set up for more disappointment here, and we actually on the back of this get a little bit of improvement. But before we carry on with that, I cut you off mid-phrase, Kayla, when you were explaining to us some of the risks. So we're not going to anchor to what happened last month. Tell us what's going to maybe happen in the next couple of months. And sorry for cutting you off there.
Oh, there was no better reason to be cut off than the CPI numbers coming out. No, I think I was saying some things that are concerning me now are even looking at the services side. I mean, a lot of the rationale for rate cutting is being driven by more softness in the labor market. Mm-hmm. Wage growth has actually been picking up in services sectors. So that could, that filtering through to those components. Then finally, on the good side, I think one thing that maybe hasn't been talked about enough is the degree to which soft goods inflation has been a helper the last couple of years. Goods inflation does tend to be softer than services inflation. That was the norm pre-pandemic, but it's been below that level. And just sort of, even if it just kind of rises to the pace that it was pre-pandemic, that by itself would make it pretty challenging to get back to 2% with services and rents as they are. So that's kind of one thing that I'm watching, if it, because we have seen a little drift up in some categories there.
Right. Kathryn, I see you over there digging deep into something. I wonder if you could take us along with you. What are you seeing, or is there anything you want to call out in the report or the market action right now?
Well, I think you're right, John. I think markets are reacting precisely because they were nervous about a potential upside surprise. So coming in dead online is a positive. It's a good thing for market participants. One thing I'm looking at is break evens. If break evens tends to widen out going forward, or even today, I think the Fed will assume correctly, and I think that expectations have moved above target. And I think that's something that, if it doesn't occur today, will occur going forward, and that an easing pause will come, meaning that the Fed potentially doesn't ease as much as expected. So I think that's where a lot of the nervousness came in, John, with the potential that there was some acceleration or some upside surprise to inflation,
right,
causing the Fed to potentially not cut in December. It seems to me, however, that we're more likely than not going to see one more Fed cut, at least in next month. But my concern, and I think Kayla is doing a great job of teeing this up, is what happens next year, because there are a lot of underlying underpriced risks, I think, in the markets. But I'm just impressed at how the S&P futures have jumped because of this inline print.
What a world! What a world we live in. Okay, but so let's go to next year, right? Because I've been following your research. You know, you commented recently that you think Trump 2.0 may be a bit lighter on tax reform, heavier on tariffs, right? So tell us what that means. You know, we're talking CPI today. We're thinking fixed income. Tell us what that means in fixed income universe.
Yeah, and before I even get into that, I'm just looking at the numbers, underlying numbers, and housing costs continue to be a major component of the inflation prints. And just Bloomberg, I'm looking at, of course, Bloomberg, the index for shelter rose 0.4% last month, and that's over half of the monthly all items increase. And when I look at even my own analyses, because what we did was we tried to make it simple for institutional investors rather than get too much into the weeds with the different minutia. A lot of portfolio managers care less about the minutia and they care more about general trends. So I'm going to pull this up here. But what's interesting to me, John, is that if you want to make it as simple as possible, there's three main components. We have core goods, we have core housing, and we have core services, X housing.
Right.
And goods are deflationary. So they're subtracting from the overall print. But the two biggest drivers of inflation, and John, this is where I'm going to more directly answer the question that you asked me. Yeah. I think the chances are that there could be a reacceleration on both fronts. So for example, core housing, let's start with core services, X housing. Why would we expect habits of consumption to change when they are robust as they are at the moment? When the economy is going to be turbocharged with lower taxes, less regulation, and a crowding in effect, less government, more private sector interaction. The wealth effect exacerbates that phenomenon to keep consumption on services very robust. So consumption of services accounts for about 1.8 percentage points of the overall core PCE number, which is about 2.6%. The rest of it is housing. And the phenomenally fascinating thing here, John, at least from my perspective, is that the Fed cut rates by 50 basis points in September, cut again in 25 this month. And what do we see happening? We see the 10-year Treasury yield moving higher, and we see no sigh of relief from the 30-year fixed mortgage rate. So hard for me to see housing decelerating, at least over the next couple of months. And over the next year, I'd tell you that I don't see any slowdown in the consumption of services.
Okay. Well, and to get into some of those numbers you're talking about, again, under the hood, you know, the October month-on-month figure in the shelter category, like people have been looking for the deceleration in this forever and ever. And you actually see it bounce back up from a 0.2 a month-on-month to a 0.4. You know, outside of that, you know, you saw strong deflation in apparel. You did see that big bump in used cars and trucks that a lot of people were looking for. Some of that I think might have been the seasonal factor. If you look at sort of underlying trends in like the Manheim auction index, for instance, it's certainly not reaccelerating, right? It's wiggling. It's wiggling around. You know, the deflationary trend may be ending, but it doesn't seem to be reaccelerating. But that shelter, it does really feel like a thorn in the side. Let me tell sort of a related story though, and let me see how this hits with you guys. So, like, to me, the surprising thing about the U.S. consumer was, you know, the Fed hiked rates, and a lot of people thought that the U.S. consumer would just sort of roll over, and she didn't. And initially, the first element of that surprise, I think, was excess savings, and then we all learned about the excess savings story, and it's sort of played out. Although, you know, choose your indicator, really. beyond that, we subsequently moved on to tapping sources of credit, right? Like a lot of people paid down credit card bills during the pandemic, and so they had pretty pristine credit. That's still a story, but those household balance sheets are less pristine than they were a couple of years ago, certainly. Then from there, you could say we moved on to a wealth effect story. A lot of people had extraordinary home equity that they could tap. A lot of people were feeling pretty good about the stock market gains, but I sort of now I hear you. If the Trump administration comes in and straight away they're like tax cuts above and beyond what you would have expected from the Tax Cuts and Jobs Act, that could change the game. That could definitely change the game. But short of that, and short of that coming in very fast, I wonder where the consumer turns next. Now that the household balance sheets are not so pristine, now that the excess savings isn't quite what it was, now that nominal wage growth is cooling, although still pretty decent, and now that in many states, like on a month-over-month basis, home prices are falling, right? I mean, just look at our home of Florida here, Kathryn, or look at Texas, and I feel like there's a story that you could sew together that maybe demand won't be as robust in the months or quarters ahead. What do you think about that? Are you buying it?
I'll give you my opinion, and then I'd love to hear from Kayla because she's more attuned and on the ground with the consumer. But it seems to me that sentiment plays a huge role in everything. And if there's euphoric
animal spirits,
if there's euphoric spirits, animal spirits, guys and gals are still gonna spend. And we still have, even though unemployment has ticked higher, it's still pretty low. People feel good. And we have something called the wealth effect, which a record high, all-time high, everything basically, S&P 500, Bitcoin, everything's just flying. People feel good. And, I think the election shows that even if the numbers tell you something, and I think Kayla very said this very appropriately, is the consumer doesn't care. So if the consumer feels good, it's all about sentiment. We saw consumer confidence come out just before the election. Surprise to the upside. Guys feel good. And if you feel good, we women, we're still going to spend the money on the nail salon. We're still going to take our vacations. And we might even do so more because the wealth effect is so potent and so strong. But I take your point. I think it's a very good one, because one thing that we didn't talk about is that, deregulation, tax cuts, reforming the government, cutting the fat, cutting the size of it, cutting spending, that has to happen if we're going to cut taxes. But it takes time. So this is not going to be on January 20 or January 21, and all of this happens in one fell swoop. So legislation takes time, and this is going to be a gradual process. But I will suggest, and what I am telling our institutional clients, John, is that the market's going to start pricing it. I think, in fact, it already has.
Yeah. Kayla, tell us about the vibes.
Yeah. So the story that Kathryn just told, I very much agree with, but I think it applies to a segment of the population. And it is the segment of the population that has pretty much dictated what the economic story at the top line has been. So it's a very valid and true explanation for what's been happening. What we are seeing in our data, though, is that there are a lot of consumers, maybe even up to, say, the median consumer, who doesn't have as much spending power, doesn't have as much power to make an impact on top line numbers in the economy, who have not been feeling good. They have been struggling. The story you told about sort of how they had savings, then they ran out. They started with, not too much debt. Now they've been racking up debt a little bit. There has been some uptick in delinquencies. There is more financial vulnerability at the lower end of the spectrum. It's been very masked by the fact that there is this strong wealth effect at the upper end of the economy for a lot of consumers. And it's enough to keep the top line numbers looking as good as they have. But there is a mix of sentiment. It seems to be a growing divergence between kind of Yeah.
That's
So
fascinating. And if I can jump in, does that mean, do you think, and I haven't done this analysis, but Kayla, you're really helping me think about this. Has the Gini coefficient grown substantially? I mean, where are we at? Because it just sounds like this K-shaped recovery everyone's talked about, where, you know, the people with resources do increasingly better. And that's where the consumer sentiment lies. But I love your kind of like the man on the street take, you know, and I think that's the most important one. So where to from here?
yeah, it's what we're seeing is more, it's less the Gini coefficient indicators and more, you know, it ties into sentiment. The fact that the labor market is strong and most people have jobs, that is allowing people to keep spending, but it's almost like, I think for a lot of the segment, a lot of the population, they're spending by force to keep up with the cost of living and not by choice.
Interesting.
There is that strong wealth effect at the top. So it really comes to sort of how they feel. So yes, they maybe are able to get by paycheck to paycheck, but because unemployment is so low, but they feel a lot of vulnerability. If that paycheck didn't come, the second that unemployment really, you know, shows more of a collapse, because a lot of the unemployment increase hasn't really been job losses. It's been the increase in, you know, immigration and things like that. So if we really do start to see job losses, I think there is a lot more fragility there that maybe hasn't shown up because each of these households doesn't have as much spending power.
Yeah. Hey, related to that, let me ask you sort of a policy question. So the Trump administration, you know, Donald Trump says he's a tariff man. And the Trump administration is probably going to do something with tariffs. There's a lot of speculation as to whether or not, you know, we should take the campaign rhetoric seriously or literally or whatever the phrase is, right? But my question to you, Kayla, is if we do tariffs, are consumers in a place to accept the pass-through inflation from tariffs, or are companies maybe going to find you know, they just need to suck it up and take the hit to their margins because consumers won't play ball with that? Like, what would your data suggest on that front, you think?
Consumers certainly aren't going to want to. They are very, very fed up with price levels as is, even after having seen some relief in prices. And we see that in some of our indexes, like we have indexes tracking price sensitivity. And what's interesting is, yes, we've continued to see consumers spending, but more often, particularly with lower income consumers, they will trade down if possible, or if they're fed up with the price, more often than not, if it's a discretionary item, they just won't buy it. It's been an increasing signal, even as inflation has cooled for some consumers. Again, at the top line, where will it shake out? I don't know, because there is, again, that very strong wealth effect from better off consumers who probably will swallow those prices. They're so used to it at this point. Kind of goes one of two ways. It's either like, we're fed up, we're at our limit, we're not going to do it, or, I've already been doing this for years. I've already been paying crazy prices. Like, I'll just swallow more. But the level of price sensitivity is already elevated. It's not like the previous, you know, Trump did tariffs before when he was in office. When that happened, we were coming from a place of sort of lower inflation. It wasn't a really high concern. There wasn't this level of elevated price sensitivity. So I don't think it would go as easily as it was accepted maybe by consumers last time.
Yeah, I'm curious to look at that too, John, because when you look at Trump 1.0, we've seen this movie before. This is not someone coming out of left field. You know, we've seen the movie before. So that means that, you know, we hear a lot of promises then or threats. And I think that we generally can agree that the tariff is a policy tool now. It's not just a trade tool, it's a policy tool, it's a negotiating tool. And it's a tactic. So this is going to be broadly used for renegotiating free trade agreements, for example, with Mexico, or ending the war with Ukraine. Tariffs are going to be a part of that. Industrial policy is a part of that. So, and we've seen this in Trump 1.0, and inflation really it's not a one-to-one pass through to the consumer. So I agree with Kayla on that. And then the other thing that I would point out is that it's interesting, the consumer confidence and University of Michigan, they've both been on an ascendant path. So this tale of two economies is really quite remarkable. And I wonder where it's going to end. And the final thing I wanted to mention, John, if it's okay, is the immigration issue that Kayla kind of touched on. And I wanted to ask you and her what your thoughts are with regard to the impact that a deterrent to illegal immigration, hopefully, and making it easier to come here legally, because that's hugely difficult and is pushing people to come here illegally. But the closure or the improvement at the border that Americans generally voted in favor of, that's going to happen. That's going to happen because Trump got a mandate, a de facto mandate, Republican House, Republican Senate, popular vote win. So what is the impact of that? I mean, if you have fewer illegal immigrants coming, will that not put upside pressure on wages, reduce the amount of supply, and potentially have an impact both on the unemployment rate and inflation?
That's a great. It's a great question. I mean, I mean, the big debate here, as I see it, and I obviously don't have have the answers, which is why I brought you guys here. The big debate here is, I mean, an economy is fundamentally people, right? So if you reduce the flow of people, or even were to do a policy of deportations, it's going to mean, on the one hand, less labor supply. It's also going to mean fewer consumers, right? And I've heard the argument that you may see disinflation first, because the first experience will be fewer consumers. But as those wage pressures sort of filter into inflation data and so forth, then maybe it subsequently becomes an inflation story. I gotta say, on this is an econ data stream, and I've read a lot of great economic analysis of the impact of immigration on the economy and wages and so forth. And my broad takeaway is that immigration is first and foremost a who are we as a country and what kind of society do we want to be, before it is an economics question. Because I think a lot of the answers to the economics questions are pretty fuzzy. What do you guys think?
I will say, on the inflationary side, I mentioned earlier that services, non-housing services price growth has been picking up, and services wage growth has been picking up at an annual basis. Immigration flows actually have slowed this year, and I don't know if these are related, but services wage growth started picking up around the time when inflation flows started to come down. And we have seen some more firming in the labor side too. So I don't know if it's related, but it definitely could be. They tend to earn lower wages.
Right.
Position effect. Yeah.
Yeah. Let me test out one further line of argument on you guys too. I've sort of had this, been exploring this idea in my column about the internal inconsistencies of this policy program. And, since we're talking about immigration, the Trump administration may say that they want less immigration, or less of a certain type of immigration. But at the moment, the Donald Trump story is a strong dollar story, and that means more people are going to be attracted to working in the United States because the value of their remittances has gone up significantly. What do you think?
That's an excellent point. I'm in the camp of a strong dollar. I think it makes complete and total sense, and that's something that my colleague John Hilsenrath and I wrote a piece on, calling for, we call it "Don't buck the buck." That the dollar is going to follow an appreciation trend if Trump gets elected, and I think that comes not just from what one can immediately expect, which is the impact of tariffs, but I think it also comes from the impact of the interest rate differentials, something that we really haven't yet talked about in depth, John. But my strong contention is that if we have a robust economy that accelerates, potentially overheats over the course of the next 12 months, the Fed is not going to be able to cut. That maintains the interest rate differential versus our counterparts, Europe, Japan. So that keeps, first and foremost, I would say the biggest driver of currencies is the interest rate differential. So the US dollar is a high yielding currency. And in my view, it's going to remain so because the Fed is unlikely, in my view, to be able to cut as much as the market is currently discounting, with the risk, which I think is underpriced in the markets. I'm a markets person, so I look at it from a markets perspective. That's why I love this counterplay with Kayla, because she's more of the consumer on the ground person. I think that's really fascinating, real economy color. But from a markets perspective, people are definitely attracted to the dollar, and I think that we could see some movement to the downside in risk assets if, in fact, the Fed has to potentially change a course. If we get a reacceleration in inflation, I think above 3.5% core PC, the Fed could actually be thinking about resuming rate hikes rather than continuing to cut. And I think but the reason I say that, John, is that I think it's the biggest risk, and I think it's the most underpriced risk.
All right. Well, listen, I want to start wrapping up here, and I want to give you each sort of a final word. The story here is that we get an inline number in the absence of all the other sort of policy uncertainty. You might chalk that up as a win. The yield on the 10-year Treasury note has traded down significantly on this number after what's been a serious and persistent sell-off in the past week. And I wonder what this means in terms of where we're going and what the risks are ahead. Kayla, what do you make of all of this? Has the data flow from today changed your mind about anything? And what could you sort of leave viewers with in terms of what to expect or look for over the next 3-4 months?
Well, when the numbers come in right at consensus, it's not a huge surprise. So, I appreciate that the lack of surprise. I'm excited to dig a little more deeper into all the categories. But it wasn't so much. I mean, I'm always excited for CPI day. I'm always going to be eager for the 8:30 watching the numbers. But it is more about sort of the risks coming ahead over the next few months that I'm going to keep watching. There's nothing today that necessarily set off new alarm bells, but I don't know. I came to this conversation a little bit nervous, reviewing the CPI data, and I'm not leaving less nervous. So.
Fair enough. What do you think? What do you think, Kathryn? And what do you think of this bond market too? After this big sell-off, how are you framing this for your clients?
It makes sense. If there was nervousness and the expectation that there could be a reacceleration in inflation, that bond yields react to the downside if inflation comes in less bad than expected. I mean, on right at target or right at consensus, if there was some nervousness about it beforehand, that's a win. So, but I think longer term, the message I'd like to leave with the audience, John, is over the course of the next year, we're very likely, given the composition of Congress and the White House, we're very likely to get tax cuts. Very likely to get them. So we get the corporate tax rate could go from 21 to 15. We could get individual tax. We're definitely going to get a Trump tax cuts extended or made permanent, and a corporate tax cut, in my view. And if that's the case, I think it's going to be absolutely essential that this Department of Government Efficiencies actually does cut spending, because right now we're operating at a bit over 6% fiscal deficit to GDP. If you add fuel to the fire of an economy that's already growing above potential, we're growing at 2.8%, potential is about 1.8%. In and of itself, that's inherently inflationary. If you add to that tax cuts, deregulation, all of these are great things. A crowding in of the private sector, all of these are great things, but it just means inflation is a real risk, and that's what I'm trying to leave with the audience. I think that it's going to be clutch that spending, which is not easy to cut because most of it is obligatory spending. It's mandatory. Medicare, Medicaid, Social Security, and interest payments on debt. Everything else is going to have to be cut, and that's going to be painful. There is space to do it, and it must be done. Otherwise, we're going to get an overheating of the economy, a reacceleration inflation, and that's going to cause problems, in my view. So Godspeed to the camp that has to, or it's intending to cut 30% to the downside government spending, and that's the target that I understand Elon Musk and Vivek have for Doge.
All right. Well, that's a great place to wrap. Thank you very much to Kayla Bruun. Thank you very much to Kathryn, Rooney, Vera. My name is Jonathan Levine with Bloomberg Opinion, and please join us again for the next data release.
Thank you.